moving on to section 3.3, which is prospect theory, and I think this is perhaps one of the most important theories in this reading. And prospect theory is a behavioral finance theory which is an alternative to the expected utility theory. So what does expected utility theory say? That's the theory that you are familiar with, that people try to maximize their expected utility. Okay, now what prospect theory says, or what prospect theory talks about, is how do individuals evaluate potential losses and gains. So this theory is trying to understand what investors or individuals are really trying to do. And essentially this theory says that investors or people use a two-step process. First, investors frame the problem or set up a problem. And this basically is how do so how investors evaluate different alternatives or prospects, and essentially how these prospects are perceived based on their framing. Framing means how you set up a problem. So when you make a decision between multiple options, how do you set up that decision-making process? That's called framing. It's also called editing. Then after you've done that, then you do the evaluation. So once you've set up your problem, you framed the issue, then you evaluate and decide on the optimal option. All right, now just more detail now on the first one, which is framing or editing. Simplistically, here is what happens. Alternatives are ranked according to a heuristic selected by a decision maker. So what's a heuristic? It's a rule of thumb, a simplification that is used. So alternatives are ranked. How is this different from your expected utility theory? How is this process of coming up with ranks and using heuristics different from... In expected utility theory, you'll use complex algorithms. You'll try to be as rational as possible, as rigorous as possible. So the level of rigor and complexity in utility theory is what makes it different from this prospect theory. So prospect theory, it's not saying that you are doing something irrational. It's just saying that you are maybe simplifying your process. Okay, now just to give you an idea, so in your framing process, and the terms framing and editing are used interchangeably. So there are 6 operations. Now, as a general remark here, actually, what I've noticed is most people don't do this, but in the curriculum, I find the footnotes very interesting. So if you read those footnotes, they are not testable, but they are interesting. So what's pointed out here is this theory is an evolving theory. So unlike many other things that you study in traditional finance, where every major finance book will have a somewhat common definition of efficient market hypothesis, when we talk about this theory, the prospect theory, different books will talk about it in slightly different ways because it's an evolving discipline. Now, one representative way of expressing this framing process or talking about the framing process is to talk about 6 operations. Now, these are the operations or representative operations that are done to set up your problem or define or frame your problem. The first is codification, where we basically perceive outcomes as gains, losses, rather than final wealth. So in our expected utility theory, we are trying to evaluate based on, say, net present value or final wealth created. Generally, in this theory, we are more concerned with the gains and losses associated with different options. Now, as another side remark, I do not think you will get problems about detailed calculations related to this stuff. So as long as you know the one line associated with these different operations, that is pretty good. So what about the second operation, combination? So prospects are simplified by combining probabilities of similar events. And if you have a slight confusion about this, this is section 3.3 in the curriculum. They give a few more examples on this that you can read. Segregation means that investors generally segregate for a given event. There might be a riskless component and a risky component. So investors tend to separate or segregate those. Now these three operations are applied to every single prospect. What's a prospect here? So when you are making a decision between different alternatives, each alternative is a prospect. So this first three operations are for every single prospect. Then for these next three are for two or more prospects, where you do something called cancellation. So you discard any common probability events. You do some simplification, where if you have a return of 49%, you might just round that off to 50%. And then if there are some items that are totally dominated by other items, so prospects that are very unlikely, you simply reject or ignore those. Okay, now again, I know that I have not explained all the details here, but neither has the curriculum. So I don't think you need to get hung up. As long as you understand that in your framing process, there are a set of operations to be done. What is the objective of these operations? It is to sort of simplify your decision-making process. That's the main point. And as long as you remember these terms and the one line, that's all you really need. Okay, now this example is given in the curriculum, so I'm going to walk you through it. I just have a feeling that this is more testable. Now, if you have two different choices and you frame them differently or set them up differently, then it is possible that there is inconsistency in your decision-making process, and that you might have inconsistent preferences, and that's called the isolation effect. Now this example is from the curriculum and I'm going to explain it. Let's say that you can make two gambles. In gamble A, you have a 25% chance of making 3,000 and a 75% chance of making nothing. Whereas in gamble B, you have a 20% chance of making 4,000 and an 80% chance of getting zero, making nothing. What do you think most people will prefer? Okay, now it's okay to use some expected value here. So which one has a higher expected value? So which has a higher expected value? So the expected value is higher. So this is a very simple expected value sort of problem. So actually, when this research was done, 65% of the people asked preferred gamble B. Does that make sense? Yeah, so most people would say, okay, even though they might not know expected value, but when I teach finance courses, the one problem that everybody gets right is the problem where you have to multiply a probability by this number. So this is a relatively straightforward exercise, the way it has been set up over here. So most people prefer B. Some people might just look at this 25%, be hung up on this. So the other 35% were probably thinking that, okay, there's a higher probability of actually making some money. So that's how they were thinking. Now you can't control how people think. So everybody can think how they want to think and make the decisions that they want to make. Now, so this was one experiment. Now, if we break this, so now this is another experiment. Now we collect a bunch of people and we now say that we have a two-stage process. In stage 1, there is a 75% chance of moving to the second stage and a 25% chance of just being rejected and not getting anything. Okay, so that's stage 1. And then in stage 2, so that's over here, then there is a 100% chance of getting 3,000 and a 80% chance of, so gamble D is 80% chance of 4,000 and a 20% chance of getting nothing. So what do you think people prefer here? Yeah, here actually a lot of people selected C. But yeah, people are saying, okay, so we made that 75% chance. So they are excited. Now they want that sure shot 3,000. But what has a higher expected value? So D has a higher expected value. So this expected value is the same as the expected value over here, right? So the point here is that depending on how a problem is framed, people will make inconsistent choices, and that effect is called the isolation effect. Interesting. Right? Very good remark. So the remark being made here is that this concept is seen quite a lot in Who Wants to Be a Millionaire sorts of programs, and I totally agree. Okay, so people are acting normally, so they are, depending on how the problem is framed, people will act differently. All right. Okay, now do you recall, so in this theory, there were two phases. What was the first phase? That's the phase we just talked about, the framing / editing phase. The second phase is the evaluation phase. So here, again, like in your regular utility theory, people compute utility based on potential outcomes and the probabilities of those outcomes. But here is what's different. And if here you can refer to section 3.3.1 in the curriculum. All right, so we are given a utility function that looks something like this. So instead of simply saying probability, we have some function of probability and then some function of value. So for x1, if the probability, the real probability is p1, we are actually using some function that is coming up with that actual probability, and I'll explain this. Okay, and then let's say for event 2, you then use some function w times p2 plus a value associated with x2. The point is this, that the way people evaluate probabilities is a little bit different from actual probabilities, and I'm going to summarize this later, but the idea is this, that generally if a probability of an adverse event is somewhat low, then people tend to overstate in their minds the probability of that happening is more than it actually is. And sometimes when actual probabilities are high, people in their minds actually think that the probability is actually lower than what it actually is. So in their minds, the probability is less than what the probability really is. So in behavioral finance, we try to get into what is in people's minds and create functions that try to say what are the actual probabilities people are using rather than what the probability should be. Now, fortunately for us, the curriculum doesn't expect us to do numerical problems based on that. All we are learning is that in the behavioral finance world, we don't necessarily use the real probabilities, we use probabilities that people are coming up with. And so that's one point. Another point is this whole concept of the value function. And here I'll refer you to Exhibit 5, and I will draw this for you. And what we will get at is this core point, that people are loss averse, not necessarily risk averse. So people are averse to losses. People are not necessarily averse to uncertainty. They are averse to uncertainty of losses or risk associated with losses. So here is the simple exhibit. If we are given gains and losses on the x-axis, so this means you are making, say, a gain of 5%, this means you are making a loss of 5%, and so on. And the y-axis represents value. The point is that as you are making gains, what's the value of that gain to you? Okay, then we have something like this. So as you are making more and more gains, obviously the value is higher, but there is a diminishing return. Another point here is that of a 5% gain, the value to you might be, say, 10 units. But does this mean that a loss of 5% means a value of minus 10? Human beings dislike losses a whole lot more than they like gains. Okay, so that's a psychological fact. It hurts your heart much more when your stock goes down by 5% relative to the happiness that you get when the stock goes up by 5%. Now, how is that depicted graphically? It's depicted graphically by something like this. All right, so a 5% loss creates, and these numbers I'm making up just to illustrate, a 5% loss creates a negative value of minus 50. Again, you don't need to know the equation. They are actually academics who come up with the equations of these lines, but we don't need to worry about that. Do you understand the main point here? The negative value of a loss is much more than the positive happiness of a gain. So in our utility function, that needs to be factored in, and that's factored in through this function over here. Now, again, as I keep saying, you don't have to solve problems based on this, but you just need to recognize that real people operate like this. In the Markowitz world, people do not operate like this. In Markowitz world, what is the measure of risk? Standard deviation. Does standard deviation worry about what's happening on the positive and negative side? Not really. Standard deviation is simply a measure of variation. It does not reflect this. Okay, so that's important. So what's the bottom line to take out of this slide? That people are really, it's better to describe people as loss averse rather than risk averse, because classic risk averse is simply saying if the sigma is high, standard deviation is high, then the risk is high. But this is what we are really worried about, loss averse. Okay, now here is another interesting exercise. So if you are given this gamble, so this is one gamble, where there is a 50% probability of winning 150 and a 50% probability of losing 100. Would you go for it? Or do you think most people would go for this? If you are purely thinking based on expected value, you would be acting rationally and you would go for it. But most people are not necessarily rational. Most people are normal. Most people are loss averse. So the thought of losing 100 hurts me a lot more than the potential pleasure of gaining 150. Okay, so what have studies shown? Most people will reject a gamble where there is an equal chance of winning and losing. But if the winning or the amount that I will get when I win is at least 2 times more than the loss, then I might be influenced. Then I might say, okay, this gamble is okay. So if I'm told that my winning will be plus 200 or maybe plus 300 and my loss will only be 100, then I might go for this. And essentially, what are we depicting here? We are depicting that if this is value and these are the returns, so we are actually depicting something like what I just showed you on the last slide. But simplistically, people worry a lot more about a loss. All right. What if the change to wealth was less than 100? What this means is 50% probability that the win is maybe 90 and 50% probability that the loss is say 50. Would that change what most people do? Probably not. Okay, so that's just a given. I think this is the main point over here. And what is this point highlighting? It's highlighting loss aversion. What if we set up the problem slightly differently? So there is a 100% chance that you lose 100, or you have this scenario, a 50% chance of winning 50 versus a 50% chance that you lose 200. So here, even though the expected value is the same, most people will prefer this, because they just don't like the fact of being 100% sure that they will lose 100. Here there is at least some chance that you will make some money. So people grab onto that chance, even though there is this ugly scenario of losing 200. So the bottom line is that there are different attitudes to gains and losses. And if I were to summarize the main points behind prospect theory over here, so this prospect theory tries to explain the apparent deviations in decision making from the rational decisions of traditional finance. Does it do a good job? I think it does a reasonable job. Is it perfect? Probably not. Okay, and why do you think it's not perfect? Can you imagine the complexity of what goes on inside the human head and human emotion and so on? Somebody tried to say that the way human beings behave, or those emotions, it's as hard or harder than predicting the weather. And why is this a decent analogy? In predicting the weather, do you know how many variables are involved? Millions of variables are involved, so it's very hard to predict. Similarly, human emotions, how the human brain is working, the number of variables is impossible to predict. So we just do our best using simplified models. So in this prospect theory world, people overweight low probabilities. So when a probability, if somebody tells you that the probability of a stock going down is 0.2, relatively low probability, but chances are that we might overreact to that, and in our calculations we might take a larger probability than that. If the probability of something going up is 0.8, that's a relatively high probability. In our sort of heuristic, or in what we try to do, human beings tend to underweight high probabilities. And then finally, something that I've said several times because it's very important, people are loss averse rather than risk averse. Okay, so now what you need to do, this is learning objective B. What you need to do now is pause this video and contrast expected utility and the prospect theories of investment decision making. So what does expected utility say, and what does the prospect theory say? Okay, now we are on the final segment of this reading, perspectives on market behavior and portfolio construction. Here again we'll start with familiar concepts and then connect them or see the relationship between those familiar concepts and what behavioral finance is. So we'll talk about the traditional perspective on market behavior. Can anybody guess what the traditional view on market behavior is? Traditional finance? What does traditional finance say about the markets? Efficient markets. So this will basically talk about the efficient market hypothesis that you know well. What is the traditional perspective on portfolio construction? Yeah, Markowitz is the big granddaddy of this discipline. So what did he say? He talked about the efficient frontier, the capital market line, and then figuring out your optimal spot on the CML. So we'll do a quick refresher of that. And then we will say why real people don't really fully follow those models. So then we'll talk about the alternative models of market behavior as well as of portfolio construction. Okay, so in terms of the traditional perspective, you are here because of many reasons, and one of those reasons is that you know the basics of efficient market hypothesis. So you know that what that efficient market hypothesis says, that markets fully, accurately and instantaneously incorporate all available information into market prices. Okay, so that is a summary of efficient market hypothesis. Okay, so do you remember what the weak form of the efficient market hypothesis was all about? Yeah, so this is a recap from level 1. The weak form of the efficient market hypothesis says that all security market data is incorporated in the security prices. Okay, so that means, what do we mean by security market data? This means past volume data, past price data. So what is the implication? If a market is weak form efficient, what's the implication? Hassan, we did this in 2010. So actually it's exactly the opposite. The implication of weak form efficient market hypothesis is that you cannot make abnormal returns through technical analysis. You can't look at trends. You can't look at the fact that the market is going up, and based on that information you can't make buying decisions that will lead to abnormal results. Why? Because any market data is already built into the security prices. So the implication of weak form hypothesis is that technical analysis will not give you abnormal returns. What is strong form efficient market hypothesis? All public information so all public information. So does that include security market information? Yes, because that is public information. So all public information is incorporated into the prices. So then what is the implication of a market being semi-strong form efficient? Yeah, so then even fundamental analysis is not going to give you abnormal returns. So now here you can take a look at Exhibit 7. So here is what Exhibit 7 does. How do you try and disprove the semi-strong form of the efficient market hypothesis? You try and take some information. For example, you can do, here is what Exhibit 7 does. It looks at the estimated alphas for 115 mutual funds. What's the alpha? The alpha is the abnormal return that you studied in level 2. So in an efficient market, what should the average value of alpha be? Zero. Because just statistically you will have some mutual funds that will be above the expected return or the required return given a level of risk, and there will be others that are below. So in this study of 115 mutual funds, you have alpha that looks reasonably normal with the expected value of 0. So what does this study show? This study shows that the semi-strong form holds. Because if you look at a whole bunch of mutual funds and on average they are giving you your normal return, then that implies that the market is semi-strong form efficient. The curriculum here at level 3 doesn't even talk about strong form. Do you recall what strong form was? It was that even private information is incorporated, but that is probably, markets are definitely not strong form efficient, so that's not even mentioned here. Alright, now are there studies that have shown that the markets are not efficient? So lots of people have done lots of studies, and some of those studies show that the efficient market hypothesis does not hold. So when some person who is reasonably well known does a study and publishes a study showing that efficient market hypothesis does not hold, what is that called? What has he found? He has found an anomaly. So you again might recall this from level 1. So what are anomalies? These are studies that challenge the efficient market hypothesis. Now over the last few decades, some of the most well-known anomalies are given in Exhibit 8. Now I don't think you need to memorize this exhibit, but you should have an idea. Because now at level 3, you need to know this stuff. It should be second nature to you. So one of the most well-known and the oldest anomaly is the post-earnings announcement drift. What does this mean? So this implied that if a company has a positive earnings surprise, those companies tend to outperform. Okay, so this study was done when? In 1968. All right, now if a study shows that companies with abnormal or earnings surprises, positive earnings surprises outperform, over the years what do you think will happen? Everybody will try to quickly buy the stock of companies that have positive earnings surprises. So chances are that if all investors are doing it, then that's not an advantage anymore. So what the curriculum, here I'll just make 2 or 3 large points because I don't think you need to actually get into the details of all these anomalies. Broadly speaking, you have 2 types of anomalies, fundamental and technical. What do you think these mean? So a fundamental anomaly shows that markets are not semi-strong form efficient. So you can actually make money based on superior fundamental analysis. And what's a technical anomaly? So these are anomalies such as the January effect, for example, or the weekend effect, where you can make money based on some technical analysis. In this whole segment on anomalies, I would actually encourage you, in general, I encourage you to read everything. But if you don't have time, then at least read this section on the conclusion on anomalies. And I'm actually going to read some of this for you because I think this nicely summarizes all that you need to know, or this summarizes the most important points. So support exists for both efficient markets and anomalous markets. What does this mean? That there are some studies that show markets are efficient. There are some studies that show that they are anomalies. But generally when there is an anomaly, what do supporters of the efficient market hypothesis say? They say that there was something wrong with the study. There's maybe something wrong with the pricing model, or maybe there is some data mining bias or some other issue which explains the anomaly. So they say that this anomaly doesn't really show that efficient market does not hold. So that's one point. The other important point made over here is that efficient market or not efficient, is this black and white or is this a gray scale? It's a gray scale, so you can't just say yes or no because it is a gray scale. And a nice point made here is that chances are that if you take heavily traded large cap stocks like say Microsoft and General Electric and so on, then the market for those large cap heavily traded stocks is probably efficient. But when you get into these small cap stocks or you get into emerging markets where the information is more scattered, less available, there is more inefficiency. And in those markets, the value of fundamental analysis will be more. Wherever there is more inefficiency, there the value of fundamental analysis will be more. So I think those points are well captured in this section. So make sure you read it a couple of times. All right. So what have we just talked about? We have talked about the traditional perspective on markets. Now we are going to talk about the traditional perspective on portfolio construction. So this is a 1-minute recap of portfolio construction from level 1 and level 2. So if you have risk on the x-axis, expected return, Mr. Markowitz created this efficient frontier, which means that if you have risky assets, then this is the best return you can get at a given level of risk. And then if we relax the constraint that you can only have risky assets and you have a risk-free asset, then you combine this. This becomes your CML. This is based on the market. It is based on the expected returns, the riskiness of the different stocks, the covariance. And then what's the optimal portfolio? That then depends on the indifference curves of a individual investor. You combine these two and you come up with the optimal portfolio. But how many people do this? All right, so that's the point. Okay, now what are the alternative models? We don't have perfect information about markets. So this is the first point made by the behavioral finance people. And investors don't necessarily act rationally. So we need something more than what Mr. Markowitz said. I think I read somewhere that even Mr. Markowitz, when he was making his portfolio, even he did not fully rely on his theory. Okay, so he considers it, but he also had some behavioral biases that influenced what he did. All right, so in this section, we will study some models that have been proposed. Now, a caveat here is that this is an evolving discipline. And the point is, if you read any standard finance book, you will see efficient market hypothesis, you will see the Markowitz efficient frontier. When I did my MBA about 10, 12 years ago, essentially the same stuff I studied then is there in most of the CFA books. It's not changed. These are the pillars of traditional finance. In behavioral finance, we don't have those pillars yet. There are lots of different theories, and those theories are evolving. So some of the more popular ones, or the ones that the CFA Institute feels you need to know, are given right here. So we are going to go over these 4 and then we'll be done with today's segment. So the first one is a behavioral approach to consumption and saving. What does the traditional model say? The traditional model says that people will exert self-control and they will make a choice between short-term spending saving decisions so as to maximize overall long-term well-being. All right, so that's what the traditional model says. The behavioral model says that people are not necessarily this rational. So people may succumb to short-term temptations, short-term satisfaction at the expense of what is better in the long run. Does this happen? It does happen. So behavioral approach recognizes that human beings have limitations. Okay, so what is proposed is this concept of mental accounting. All right, where essentially this is one way of framing, where the money that you have, you put in different buckets, even though money is, and here is a new vocabulary word, fungible. Fungible means, I don't know who came up with this word, but it's a word that means money is interchangeable. All right, that means that you can easily bring money from the future into the present. How? By borrowing. And you can put today's money into the future by saving. So money is interchangeable, but people create this mental accounting, so they segregate money. How do people segregate money? They put it in these buckets typically. There is current income. So people have a regular income that's coming from your job. So that is considered current income. Then there is your currently owned assets. Maybe the extra money that you put into savings, that now is your asset. And then the present value of your future income. So money that you will have in the future. For most people, they are more likely, or most people spend more from the income that they get. So the propensity to consume from your current income, from your regular income, is much higher than the propensity to consume your assets. So if you have some savings, which are your assets, you are less likely to consume that relative to your regular income. And you are even less likely, hopefully, most people are less likely to consume money by borrowing. So when you are borrowing, what are you doing? You are essentially picking up your future income. So unless you are the government, you generally don't do this. Okay, most people don't do this. So mental accounting and framing will result in some saving for long-term goals, but the outcome will not match optimal short-term and long-term consumption. So what most people will do here is, if they need to spend, they will spend first from your current income, and then the excess will go either into your current assets or into your longer term savings for the future. So that's one point. When you spend, where do you spend? First you spend from here, then you spend from here, then you spend from here. Now, is this logical, rational? This might not be totally rational, because it might not end up with your optimal long-term solution. But it is I almost call this a mind game. Sometimes you play with your mind in order to psychologically make you behave in a better way. So people do this. For example, I didn't realize this, but my mom does this all the time. So she says, okay, this money you allocate for this. This extra money you allocate for something else. So people just automatically tend to do this. Put money in different buckets, and then those different buckets of money are allocated for different functions. So what's this called? Is this a way of framing? It's one way of framing. And what's this thing called? It's called mental accounting. That's what you need to know. Next, a behavioral approach to asset pricing. When you say asset pricing, what should immediately come to mind? Harun, asset pricing, what should? The moment you hear CAPM, you hear asset pricing, you hear CAPM, capital asset pricing model. Okay, now in capital asset pricing model, you basically come up with the appropriate discount rate to use for a given asset, given the beta or the riskiness of that asset. That's traditional finance. Now, what does behavioral finance say? Okay, so investors display biased behavior, which results in less than optimal decisions. This is a high-level remark. And then here is the fancy terminology to learn from here, and then I'll explain this. Behavioral stochastic discount factor based asset pricing models. What does this mean? The fact is that, and you can probably relate to this, do you think asset prices, by assets I mean stocks, do you think asset prices reflect investor sentiment? They do. They generally do. When sentiment, let's say between time A and time B, fundamentals are the same, but for some reason sentiment has gone down. What will happen to asset prices? Go down. So then it makes sense that there should be some sentiment-oriented factor that is reflected in the discount rates. So essentially what's happening is, let's say the projection of the cash flow for a given asset has not changed, but the price has gone down. What does that mean? That means that now you are using a higher discount factor. So that increase in discount factor, where is that coming from? That's coming from the sentiment. So that means that there should be a way of measuring sentiment and then reflecting that sentiment in your discount rate. Makes sense, doesn't it? But what's the challenge now? How do you measure sentiment? The proxy that people use is the dispersion of analyst forecasts. Now, analysts have forecasts of earnings per share and cash flows and so on. So we don't need to get into details here, but studies have shown that if there is a high dispersion in that analyst forecast numbers, what does this high dispersion mean? So you take the 20 analysts that are evaluating a given stock, and there is a very big spread in terms of their forecasts. So when the spread is high, that implies that the sentiment is negative. Okay, just take that, the curriculum says it, so it must be true. Okay, so now what do we do? And fortunately for us, we don't need to quantify this, we just need to understand high level. So if that dispersion is high, then that means that the sentiment is low, and that means that we should be using a higher discount factor. Okay, now if you want to make money out of this, what will you do? You will recognize maybe that the sentiment is irrationally low right now. So I'm just adding to the curriculum here, but if the sentiment you believe is irrationally low, what should you do? You should buy, because that sentiment is reflected in asset prices. And if you have reason to believe that that sentiment is not justified given the fundamentals that you see, then it makes sense to buy. So this is called the behavioral approach, where you are, what's the one line to remember in the behavioral approach? That you need to add the element of sentiment to your discount rate. Okay, next, behavioral portfolio theory. So this is, again, in all these theories, I think from an exam perspective, you contrast with the traditional model. So that's the way the learning objectives are stated, and that's the way I'm trying to explain this also. So what does Markowitz's portfolio theory say? I've covered all these items already, plus you know these quite well, hopefully. Now, what does behavioral portfolio theory say? So now, rather than using real probabilities, we are using some probability weighted function that I've talked about earlier. Another important point is that people don't just create one big diversified portfolio. People think of portfolios in layers. So they say, okay, this is my layer which is my risk-free assets. This is my layer which is moderate risk, and this is my layer which is very high risk or speculative. So people think of their portfolio in different layers. Return expectations and attitudes to risk vary between the layers. So for the high risk or speculative layer, your attitude to risk might be almost risk seeking, as in your risk aversion level would be much lower at this layer, and for this layer you are like 100% risk averse. You don't want to take any risk. Is this different from a Markowitz investor? Yeah, because in a Markowitz investor there is no concept of creating different layers, and one investor will, do you remember at level 1, some of you who've done it more recently, you actually have this thing called A is equal to 3. A risk aversion level is assigned. Now this completely shatters that, because this is saying that one investor can have 3 different risk aversion levels depending on which layer we are talking about. And diversification is not necessarily the objective. So diversification might happen, but that is not necessarily the objective. So I think I've tried to capture the most important points here. All right. Now what I want you to do for homework, given what I've talked about, you need to do example 3, which talks about this concept. It talks about creation of a portfolio using behavioral finance. And you are actually called, as in there is this term that they use called a behavioral portfolio theory investor. So an investor who subscribes to the behavioral portfolio theory. And the one term that I'll just introduce, which will help you with this example. So this investor has 2 million euros. That's how much money he has. And there is this concept of an aspirational level. An aspirational level means that he wants to make sure that at the end of his investment horizon, he has at least 2 million euros. So the point is he doesn't want to lose anything. So what sort of a portfolio do you think you will create for this guy? Very conservative, so you'll put everything in the risk-free asset. The next guy has 2 million euros also, but his aspirational level is 2.1 million. So he's actually hoping, expecting, going for roughly a 5% increase. So for him now, we need to create some layers, put some money in the risk-free, because it's not like he wants to take huge risk either, but at least he wants some return. So you can't just put money in the risk-free. The risk-free asset in this example is only giving 1%. So he needs to put money in something that gives a higher return. So not a difficult example. One general point about level 3 is the complexity of calculation is much less than level 2. So if you didn't like calculations, you'll be happier. But there are many other theoretical things to worry about. So anyway, you will get used to that. Okay, now this is the last point, which is adaptive market hypothesis. So the larger point here is that if you have high competition for scarce resources, so let's say that the hedge fund industry is what we are talking about. Hedge fund industry needs very highly qualified people. If there is very high competition for those resources, and let's say a hedge fund has a very specific strategy and it's not adaptable, and maybe that strategy is not working. So when you have these two elements, then the likelihood of not surviving becomes high. And this is compared to evolution. Plus, interestingly, the curriculum has also developed a sense of humor at level 3. So this is not my example. This is actually, I've just put a slight twist in this, but this is from the curriculum. So we will end this class by thinking about what do pandas and long-term capital management have in common. Okay, so the point is, and I sort of knew this, but I learned it from the curriculum. Pandas are not very adaptable. They can only eat bamboo. So if they are in a bamboo jungle and you cut out the bamboo, they'll die. They'll not survive because they cannot adapt. Long-term capital management, hopefully you remember their case from what you've studied before. They had a very focused strategy that involved, I don't know if you remember this or not, but they would, they would do a lot of leverage, and they would rely on T-bills and the arbitrage between on the run and off the run T-bills. When there was competition in the market, rather than adapting and changing strategy, they went for more leverage. And ultimately they went bust. Okay, so what's the point here? They were not adaptable, so they did not survive. Just like if pandas are not adaptable, you remove the bamboo, they will not survive. So this is your adaptive market hypothesis. All right. Now for homework, you are going to do this. Just compare the traditional finance perspective on portfolio construction and the behavior of capital markets. So this would be a summary of the points we have just talked about. Go over these notes, review the examples, and then do the 6 practice problems at the end of this reading.